Well, hey everyone. Welcome to another live. We will be doing Tesla today. Yep. The most awaited, the long awaited call because well, I was hoping to actually do this with the SEC filing in place, but they have not done it yet. So, it'll probably be done next week. But yeah, anyway, let's go live. Let's do this. Let's go live and check out how insane the numbers are qualitative wise. If we have time, hopefully we'll go through the transcript as well. So in this format, I'll literally just be, looking at everything live and just reading through everything qualitative wise, quantitative wise, what the Elon say. The transcript is very long. Hopefully we can actually, I don't think we can actually go through that within this time, but yeah, let's begin. So let's look at it together. If you guys are here watching this live with me, appreciate it if you guys smash the like button, smash that heart button, spread the algos. There'll be good content moving forward because the markets are rough, right? Let's put it that way. The markets are really rough. So we just need to strengthen our mindset. We need the mental model, thought process there, and not just simply buying on the dips, which is what we have been preaching ever since the beginning of the year. Don't simply buy on dips just like that. The markets are going to just trash all these companies, right? So again, I don't want to take too much time on the macroeconomics, but I really think that it's very important for you guys to actually know what's happening and just strategize our portfolio forward, because I see people losing money since 2021, having a portfolio drawdown of 50%, and it's not, it's not pretty, right? It's not pretty. So again, if you guys want to contact me individually, just let me know, tag my name in the group, and we can have a good conversation. Anyway, moving forward, again, if you guys are watching this live right now, appreciate if you guys can click #live so that I know you're here. If you're watching this on replay, click #replay so that I know you're here as well. And smash that like button, right? Show our brothers some love. Smash that like button, smash that heart button, just spread the algos, and there'll be good content moving forward, guys. So let me just fix this up right here. And I'll go here. Okay, awesome. Awesome stuff. So let's begin. Now, Tesla, am I sharing the same page? Yes, I am. Okay. Highlights, financial summary, operational summary. This is the usual format. Now, highlights. Operating cash flow less capex, free cash flow of 2.28 billion. Now, I always look at free cash flow in quantum with versus the quantum of the market cap, which you can't really compare. It's Tesla, right? 1 trillion market cap. They'll probably go bigger. But 2.28 B in Q1 alone is actually really strong, right? Really, really strong. So total debt X vehicle and energy product financing under 0.1 B. You see how lean Tesla is getting? Their OPEX, not mistaken, is actually way lesser than Rivian right now. And Rivian is just in, the starting years. Tesla is at this size, Rivian is so small, and yet they are getting so lean, right? So this is really, really interesting stuff. Profitability, 3.6 B gap operating income, 19.2%. Now, what I have here is actually operating margins versus all the other car companies. Now, people say that, oh, Tesla is just a car company. Well, there you have it. Let's compete at a car company level. Operating margins are already higher than these guys, right? Tesla is number one. Well, not really number one. Orange is Bales, Zurich, Motoren Work, 12.09%. Tesla's at 12.07%, right? So just dug up this and thought I wanted to be sharing with you guys. So 3.3 gap net income, 3.7 B non-gap net income X stock-based compensation in Q1, 32.9% gap automotive gross margin in Q1. Now, this is not your typical growth stock anymore. It's not like adjusted net income, adjusted the non-gap, it's all gap stuff. And when you got gap automotive gross margin at 32.9%, that's insane, right? Production and delivery started from Gigafactory Berlin in March, Texas, April. Summary, the first quarter of 2022 was another record quarter for Tesla by several measures such as revenue, deliveries, operating profit, and operating margin of over 19%. Outstanding recourse debt has fallen below 0.1 B at the end of Q1. Public interest in a sustainable future continues to rise, and we remain focused on growing as fast as reasonably possible. Expansion of our production capacity is core to our decision making. In the past 2 months, we began deliveries of Model Y. At the same time, we are putting significant efforts into in-house cell production, raw material procurement, and supply diversification. Challenges around supply chain have remained persistent, and our team has been navigating through term for over a year. In addition to chip shortages, recent COVID-19 outbreaks have been weighing on our supply chain and factory operations. Furthermore, prices of some raw materials have increased multiple fold in recent months. So despite all of that, despite chip shortages, despite COVID-19 outbreaks, shut down the factory, supply chain disruptions, well, they're going to get a hit for Shanghai shut down, right? So far, it's been 2 weeks. They already, they were lenient and they actually opened part of it, 8,000 workers. That will remain better. But, we are expecting a disruption of nearly, 2 weeks, maybe maximum of 30 days annualized of vehicle production, right? Which is, it's just a small amount, but it's still going to affect Q2 numbers, right? So furthermore, prices of some raw materials have increased multiple fold. Okay, we said that. The inflationary impact on our cost structure has contributed to adjustments in our product pricing, despite the continuous focus on reducing our manufacturing costs where possible. We would like to thank everyone. Okay, cool. So automotive revenues, Q1 2022, record high, year-over-year increase is 87%. Awesome. Awesome stuff. You don't get this type of, you don't get this type of growth for car companies anymore, right? Let's put it that way. Regulatory credits grew as well, and just a small portion. Automotive gross profit, 5.3 B. So if you want to actually sort of, let me bring up my calculator here. You want to navigate their gross profits for automotives, it's actually 32.8%. That's insanely high, right? So what is the reason why they can actually get so high? There's only two ways. You reduce your cost of revenues or you increase your revenues. It's as simple as that. And this, they don't curb demand. Demand is not affected. Production is affected. They can't keep up with demand. That's as simple as that. So when sales prices are, skyrocketing, and they can do that, they have pricing power. They can say, okay, let me raise my prices. My ASPs are higher. My margins are higher. There you have it. It's a solid business, right? So automotive, all right, yeah, the 32.9% gross margin. Total revenues, 18.7 B. Gross profit, 5.4. And GAAP gross margins are 29. So for a group, that's good, right? Because they're not doing so well in, on the energy sector as they should. I mean, not as well as automotive revenues. That's why it's sort of dragging it down. But total GAAP gross margin of total revenue is actually really strong. Operating expenses, 1.8 B. 1.8 B. Operating expenses. Now, we got companies where we're looking at Square. We are looking at, I know it's not apple to apple, but think about it. These companies that are, Tesla is way down in the S curve. Companies like Square or growth companies that are way lower down in the S curve are spending 1.8, 2B, 3B in operating expenses. And you have Tesla, a monster of a company, $1 trillion company right now, having 1.8 B expenses. You know how crazy that is? You know how lean that is? It's insane. Income from operations, 3.6 B, operating margin at 19.2%. That is just crazy high, right? Adjusted EBITDA. So I'm not going to look at adjusted EBITDA anymore because, GAAP is what matters, right? So net income GAAP wise is 3.3. We are looking at, and this is total, right? So we are looking actually 3.3 divided by total revenues, 18.756. We're actually looking at 17.5% for the quarter. If they can maintain that, so we did our back of the envelope valuation, and it shows us that they can achieve 15 to 20% net income. Now, they're already achieving 17.5% in this quarter. If you were to analyze that and assume that's, not factoring the growth, not assuming everything is stable, and they continue 17.5%, that already outpaces what we have projected since, all the way to 2025, which is 3 years more, right? So again, the game plan of Tesla is that they have to remain profitable by selling higher or just remaining the sales price not too high, being more lean. They can definitely get that margins. They can expand margins. This is one of the companies in, the S&P that can actually do that, right? That ticks out all the boxes, pricing power, lean, low debt, net cash, blah, blah, blah. So, on a GAAP net income basis for a car company that you guys like to say, they're already profitable at 17.5%, right? Net income basis for the quarter, right? So EPS contributable, okay, that's cool. Net cash, 3.9 B. Capital expenditures, 1.7. So it's supposed to be a capex heavy industry, right? But 1.7 B for this size of a company, again, with, total PPE of this much, and it's actually very lean. I mean, this is really good, right? So that's why their free cash flows can actually get into 3B, 3.3 B, right? So, free cash flows at 2.2 because operating cash flows is that, and then you minus off PPE and you get free cash flow, which is still very strong. Cash and cash equivalents is 17B. Again, they do not. This has already been said, right? They do not need to depend on financing anymore. To expand gigafactories, all they need to reserve is 5B maximum full capacity for per gigafactory, and that's really big already. So 5B, they can open up easily 2 more, and as they get more net income along, and that compounds, they can easily grow. Obviously acquire more gigafactories. Now, see, that's the game plan. That they need to scale faster than expected, right? If we work in a rate of 2 gigafactories per year, they can definitely achieve that 50%. 50% CAGR growth is actually there. But in order to speed that up and not have that delay when you have, building on a year over year, like you imagine you have that Gantt chart and you want to recognize revenues, they need to scale and open up more gigafactories in order to actually keep up that pace, right? The momentum. So, that's what they have to do. And and it's cool. They just opened up. We just need to see what's happening, in the following year, where they're going to open up next. And, gigafactory construction could be like 1.5 to 2 years. So it takes time. But then again, keeping up with the original capacity that they have versus their valuation already puts them parking at like 150 PE and forward P of 90, right? So we got growth stocks, not even profitable. So what I'm doing is actually I'm comparing with the market, right? I'm comparing with the deals in the market. People talk about growth stocks. People talk about, that. We got a monster company right here growing at 50% CAGR. And, they can already be profitable, potential 90 PE wise versus the valuations today. Now, with the macro environment where, market cap and all that is actually going down, their PEs will be even more attractive, right? So that's key to consider. Total revenue grew 81% year over year. Revenue was impacted by the following items: growth in vehicle deliveries, increased ASPs. That's music to my ears, right? In this environment right now, if you can increase your ASPs, so think about it. All the investments that I've been preaching so far has been increasing ASPs all the way. We got commodity related companies, we got inflationary beneficiary companies, we got Tesla, obviously. And those companies that can afford to increase ASPs, especially at these times, they're going to try because their margins are going to be expanding, right? That's the key difference. But obviously what we've been seeing is that the market doesn't care about ASPs. They don't care about profitability. They just care about the sector, right? Consumer staples are the one to go, defensives, whatever. But what I'm trying to say is if they can continue this trend along the way, now obviously recession is a big hit that will affect everyone. But if they, during good times or moderate times, if they can increase ASPs, that says something about the business, right? So growth in other parts of the business, profitability, our operating income improved to 3.6 billion in Q1, resulting in a 19.2% operating margin. Awesome stuff. This profit level was reached while incurring SBC expense. attributable to 2018. Okay, so we went through this before, and was reached while. Well, we had a similar thing of SBC since the last quarter, Q4 of 2021. So this is a 2018 CEO award of 48. They can even achieve that with this compensation, this CEO award, right? So other metrics will be growth in vehicle deliveries that increase profitability, increase ASPs, reduce COGS per vehicle. This is, again, music to my ears, right? The definition of scaling is streamlining costs, increasing revenues, and this is exactly what they're doing, right? Despite inflationary pressures, lower stock-based compensation expense, awesome, increase in regulatory credit sales, and the negatives are obviously rising raw materials, commodities, logistics, and expected costs, increase in operating expenses. Like the way Tesla is run, and we all know this, right? Tesla fans, they are run like the biggest startup in the world. Let's put it that way, right? The startups, what they do is that they make sure, I mean, good startups, they make sure that every single thing is looked at into detail, and that minor contribution in decreasing costs can compound and snowball into a huge sum if correctly done. And that's what Elon does. You know, he's amazing. He's talking about business acumen. Like, that's why I was so bullish, even though when he was gonna announce to, you know, acquire Twitter, I'm very sure he can do a great job. I mean, if you can run and grow a car company, you can do any company, right? Anyway, quarter end cash equivalents sequentially by 0.3B to 18B in Q1, driven mainly by free cash flow of 2.2, partially offset by debt repayments of 2.1B. Our total debt, excluding vehicle energy production, product financing, fell to less than 0.1B. That's insane. At the end of Q1. Okay, so Model S production has been great, has been growing. Okay, Model 3 Y has been stagnant. Total production 305. See, total production 305, and we have deliveries at 310. So this is SX, EY, 14,000. So SX is growing, but you know, stable. So here's the thing: the amount of deliveries are similar to Q4. Well, lesser a little bit, but yet they can have record, you know, revenues, record profits. Why? Again, it's because of ASPs. They can afford to raise prices and not curb demand, right? So this is the key thing to take note of when we want to build a bullish thesis on, you know, Tesla. Total end of quarter operating lease vehicle count. Okay, solar deployed. I'm not going to go through solar today. Vehicle capacity. So California, Model S capacity, Model X, 100,000. Okay, so total of 600,000 here. Shanghai is above 450,000. They're actually ramping up and building their new phase. Berlin, early RAM. Okay, so they can easily get up to, you know, this capacity. They will park them at more than 2 mil. I mean, full capacity, more than 2 mil cars with all the gigas that they have, which is awesome. A year, imagine. So we are slowly, remember the TAM that we highlighted right before is that by 2030, which is just 8 years from now, right? Very fast. They will be selling 20 mil cars, right? 20 mil cars. And this is covered by a lot of media and analysts. 20 mil cars on the road per year by 2030, EVs. And that's really possible, right? Knowing you know, with all the players in the space ramping up production, with all the players in the space just, you know, into EVs, that's the new trend, obviously, that's the new market fit. 20 mil cars, is that possible? And we see by then how many X amount of because we always talk about TAM, right? TAM this, TAM that, total addressable market. Tesla is the only company that I see so far that can actually grab that huge TAM and is logical, realistic. We got companies like SoFi, Upstart, right? They have $3 trillion TAMs, which is cool. But how are you going to grab so much of that? Can you grab 20% of that in 10 years? No way, right? The space is huge, a lot of competitors. But when you talk about Tesla, 20 mil cars, how many percent market share can they grab? 40%, 50%. Well, I don't want to be too optimistic. It's enough to even grab 30%, 20%, 25%, which I think is really possible. You can expect to see huge revenues just on the automotive side. Not even talking about Tesla bots, Tesla insurance, robo-taxi. Just talking about automotive and revenues versus with whatever margins they're actually having now. We can actually navigate the potential valuations from there, and that is what that's what's keeping me invested more and more, right? The short-term plays, the thematic plays that I'm actually hedging on, I pile it onto Tesla. It's as simple as that, right? Every month. So this is something to think about. In Q1, we saw a continuation of global supply chain, transportation, labor, and other manufacturing challenges. Okay, in April 2022, we began Model Y deliveries in Austin, Texas, a Cyber Rodeo opening party. 4680 in-house made cells, single piece from body castings. Okay, that's important. We expect Gigafactory Texas will be able to produce Model Ys, structural packs. Cool. While weekly production rates were strong in Q1, a spike in COVID-19 cases in Shanghai resulted in a temporary shutdown, although limited production is started. Okay, so that's the setback, right? So what to expect of Tesla is that Q2, especially numbers, if you are following up, on quarter to quarter, which to me doesn't make sense because we're invested for a long haul anyway. But Q2, expect the price to be sort of going down because they'll have disruptions, right? Numbers will not be as sexy as usual. But knowing Elon, he'll probably pressure the team and say, hey, it's time to keep up. We have to, please shareholders, right? So production at Gigafactory Berlin started in March using non-structural packs with 2170. Ultimately, Gigafactory will be able to produce Model Ys using both structural packs with 4680 cells as well as non-structural packs 2170 cells. Cool. So market share of Teslas by region. There you go. 2.5%, and it's growing. It's growing really well, right? And this is just, market share of vehicles. On the EV space, they're already grabbing 20%. But this is, insane. It's actually growing. So FSD, with 7 software updates in 2022, our team continued to work on reducing disengagements, particularly focusing on unprotected left turns. Now, the highlights that I read that's actually been crazy around in the media is that they'll be ready by 2024. And I believe that. So you got, obviously you got regulatory approvals, you got government, regulations, and you need to make it to a acceptable commercial level. So there's no accidents, everything is precise. They're still gathering data. Do we think that they can actually make it? Right? I personally think so. 2024 is just 2 years down the road. And we know Tesla can be a 10 billion revenue generating company in 2019. No, I forgot what's the amount. And right now they are a 70 billion revenue generating company in 2 years, 3 years, whatever. They can definitely pull this off, right? And I know it's a matter of technology. I know it's a matter of precise, which is what the team does actually. But 2024 is actually not far-fetched, right? It's actually not far-fetched. And with all the data they're actually gathering, it's possible. So in Q1, we added mobile app controls for climate control modes. Cool. This vehicle software. UI with metallic matte finishes. We also improved charging time, estimation accuracy by accounting for battery temperature. Okay. Child log. So battery, powertrain, and manufacturing. This is why nearly half the Tesla vehicles produced in Q1 were equipped with the lithium iron phosphate LFP battery containing no nickel or cobalt. So this is why they can also ramp up margins, because nickel and cobalt, Elon is just crazy. He's already foreseeing that, all these metal prices will be escalated. So, well, I mean, obviously he did not know about the war, but again, he has been decreasing and reducing the use of cobalt all the way, right? Trying to reduce the cost of nickel anyway. So cobalt is expensive. It's harder to mine. It's no point in using cobalt. So the technology that is focused is actually, into making a better ass battery. Well, nickel prices are skyrocketing. Half of vehicles produced in Q1 is LFP. No nickel, no cobalt. That's why their margins can increase, right? All these little details that they spend on, they can actually do. So this is, This is really good news, right? Currently, LFP batteries are used in most of our standard range vehicle products, as well as commercial energy storage applications. As a result of our energy efficient motors, our Model 3 with an LFP pack can still achieve a 267-mile EPA range. That's awesome. That's awesome. So, and this is really what blew my mind. So the day after Super Bowl, that the Super Bowl effect, right? That's what he calls it. Vehicle gross orders in the US was crazy high, right? Compared to the competitors, we're actually spending more top dollar on, media coverage and DTC, whatever, media spend. No single spending on media or marketing. And yet the vehicles deliveries grew, the orders grew, right? Insane. What company can do that? And this is what blows my mind as well. Exactly what we were sharing just now in operating margins. So GAAP operating margin, I don't care, right? Daimler, Hyundai, BMW, whatever. Tesla's on the top, already close to 16% operating margins, GAAP wise, TTM, right? Trailing 12 months. That's awesome news. So energy storage deployments increased by 90% year over year. Okay, that's cool. Solar services and other services gross margin remain close to break even. That's what's dragging them down, right? The services side. Tesla insurance safety score, services and other gross margins is actually increasing and improving. That's really, really good. Plan to grow our manufacturing capacity as quickly as possible. Over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. What company right now can have 50% CAGR on the safe side? Not many, right? Not many in the market. So the rate of growth will depend on our equipment capacity, operational efficiency, and the capacity and stability of the supply chain. Our own factories have been running below. Okay, we have sufficient liquidity to fund our product roadmap, which is great. They want to expand two more gigafactories, no problem. They can even pay in cash as long as they don't acquire more Twitters. Long-term capacity expansion plans and other expenses. Okay. Profit, well, we continue to execute on innovations to reduce the cost of manufacturing. We expect our hardware-related profits to be accompanied with an acceleration of software-related profits. The pace of production ramps in Austin and Berlin will be influenced by the successful introduction of many new product and manufacturing technologies. Factory ramps takes time. Yes, it does. We are making progress on the industrialization of Cybertruck, which is currently planned for Austin production. See, what Tesla does, they break the wheel. They don't try to follow the wheel, right? They break the wheel entirely. Break the wheel in margins, break the wheel in type of product, break the wheel in design, break the wheel in terms of they are the market leader, right? Companies are actually working towards to reducing cobalt, nickel, designing better because of that, So that's what makes this special. It's obviously a good day to be owning Tesla, to be a Tesla shareholder. Let's put it that way. Body structure. Okay, so we got key metrics. Vehicle deliveries improving really nicely. Now, Q1 compared to Q1, we can actually see a little slowdown, possibly, until it reaches Q3 and Q4 based on seasonality. We can actually see the slowdown because of actually what's happening in the market as well. If demand, is curbed, then we can obviously see these deliveries going slower as well. But the key thing is, with this, the beauty is that with this amount of deliveries, with them reducing, again, with whatever that they're doing, right? Reducing costs, rising ASPs, they can still achieve good profitability margins. So that is something to take note of, right? Operating cash flow versus free cash flow has been obviously growing really nicely. Net income and just the EBITDA, okay. We got trailing 12 months deliveries improving nicely. Hopefully they can achieve that 50% year-on-year CAGR, even though during a bad volatile time. Operating cash flow, free cash flow growing really nicely. Net income and just the EBITDA growing really nicely. So financial statements, we talk about Q4 alone. Total revenues are at 18B, which is what we saw just now, 5.4. Income from operations, net income is 3.3. Again, this is like a 17% margin, which is awesome. So balance sheet, let's check out our balance sheet a little bit. We have cash in the bank, 17B, short-term 508M. Accounts receivables, not much, which is sexy. Inventory, 6.6, waiting to be loaded out. Total current assets, 29B. Operating these vehicles, okay. Property, plant, and equipment, obviously is worth a lot, but the maintenance, capex, is actually just, close to, I think, 2B just now. Let's see, total current liabilities. Yeah. Yeah, it was actually mentioned that it was around 2B, not mistaken. So operating the realized lease right of use. Okay, other non-current assets puts their total assets 66B. There's no, well, very little goodwill, obviously. No, I mean, there were never any red flags, but there was no sign of bad because, not that high inventory. Well, it's quite high, but as we know, so the thing about inventory is that we have to know whether or not they can translate that into cash. It's as simple as that. When can they sell? And in, obviously in Tesla's case, it's not enough inventory because the demand is not affected. So that's not something to worry about. Total current assets 29B, which is really strong. 17B in the bank is already very strong. So 66B total assets. Let's talk about liabilities. 11B versus, no, yeah, it is 11B. Okay, accounts payable. Well, okay, so that versus the cash is actually not to say concerning, but it's quite a big amount anyway. So 5.9 deferred revenue is small, which is great. Total current liabilities is 21. So it's not exactly very, very sexy, but as long as that's more than that, and it's a substantial amount, is great. Debt and finance leases, long-term liabilities at 3.3. Okay, so total liabilities at 30B. Okay, so debt and finances. So the debt and finance leases is at 3B. Deferred revenues at 2. Other long terms at 3. So we can actually put them at long-term debt at like 6. So other long term is 3.8. We plus that with 3.1. That's just 6, 7B. That's nothing compared to how much they're earning per quarter, compared to how much they're earning per year. That's actually nothing. So they're slowly paying things down, and that's what we can see, right? If we were to summarize everything, rising ASPs, lower costs, paying off debt, which is exactly these three things is exactly the pattern of the type of investments I'm actually finding for thematic plays this year. That's the pattern going forward. That's a great business, right? So those three, good optionality, obviously good growth, obviously great CEO in their case, and yeah, these are the sort of key points that we want to find out during these times right now. So we got cash flows, net cash, operating cash. They have 3.9B. Net cash used in investing activities. So capital expenditures is actually 5 million. Okay, right. So purchase of sales, proceeds from sales. So yeah, investing activity is actually not much. Cash flow negative 1B. Okay, so that's where they highlighted, right? So that's the investing activities at 2B. So financing is at 1.9. Okay, so it's really healthy. These are really low numbers, really, really low numbers. If you were to use the discounted cash flow to work out Tesla's valuation, you'll probably get a very low figure. So you can't really work that out now. We are investing for the future. And the question is, will this grow to 10B, which I really think it will, operating cash flow, as long as they grow KGAR, right? And continue what they do, and the net income is actually realized. And this is just for the quarter, by the way. This is just for the quarter. If we add up all cash flows, they could easily be, up to how much? 4, 7, 8, 11, 13B already, right? So anyway, that is net income. So these are the numbers. Net in millions, net cash. Okay, adjust the EBITDA. There we go. There we go. So we don't have time to look at the earnings transcript, but the highlights that I picked up was that robotaxi is coming. They're still concentrating on robotaxis as their focus. They already highlighted that there's rumors that actually robobots are actually moving around the factories already. They see that as a bigger new S curve and bigger TAM to capture. Their ASPs, they expect to do higher ASPs, which is great. So I'm just going to look through this, looking ahead in the immediate term, a few things to keep in mind for Q2. First, we've lost about a month of build volume out of our factory in Shanghai due to COVID. See exactly what I said just now, right? A month. Production is resuming at limited levels, and we are working to get back to full production as quickly as possible. This will impact total build and delivery volume in Q2. Second, as I mentioned before, Austin and Berlin are just starting their ramps, and thus those inefficiencies will start to flow through our gross margins in Q2. So, Q2 will be rough, right? Third, we do have higher ASPs in our backlog, which will help to offset some of these headwinds. We continue to drive towards further strengthening of our financials in the second half of the year, and believe our 50% or above growth rate remains achievable for the year. Music to our ears, guys. Right? OPEX as a percent of revenue continues to reduce, driven by higher revenue, lower stock-based comp expense, and other items. As a result of our ongoing improvements in the operating leverage, we achieved a record operating margin of over 19%. Note that commissioning costs for over factories are in R&D as Berlin started production in late March and Austin early April. These costs will be in automotive costs going forward, given these factories are now producing customer sellable cars. Right, so I'm just gonna go keyword and robo-taxi. So we're working on a new vehicle that I alluded at the Giga Texas opening, which is dedicated robo-taxi that's highly optimized for autonomy, meaning you will not have steering wheel or pedals. And there are a number of other innovations around it that I think are quite exciting. That is fundamentally optimized for trying to achieve the lowest fully considered cost per mile or cost per kilometer, counting everything. And so it's, I think, going to be a very powerful product. Maybe aspire to reach volume production of that in 2024. So I think that really will be a massive driver of Tesla's growth, and remain on track to reach volume production of the Cybertruck next year. So Cybertruck next year, I like to thank Tesla employees. Okay. Optimus, and then there's of course Optimus, which I was surprised that people did not realize the magnitude of the Optimus robot program. The importance of Optimus will become apparent in coming years. Those who are insightful or listen carefully will understand that Optimus ultimately will be worth more than the car business, worth more than FSD, which is already big in quantum, right? Uber, Grab, Lyft, I don't care who you are, they're definitely going to be affected. Owning a company will be an asset moving forward rather than a liability, right? So really exciting times. That's my firm belief. So, and then of course, insurance is growing well. We expect to address the part shortages that limited our progress with batteries and solar. So we expect batteries and solar to also grow well this year. And basically the future is very exciting. I've never been more optimistic or excited about Tesla's future than I'm right now. Awesome stuff. So what else is on Robotaxi? It's basically zero for Robotaxi. It doesn't, for Robotaxi, yes, it doesn't make sense. No, sorry for this. Sounds good. What is that? Sorry, 100. Okay, especially. Anyway, guys, that's all for today. That's all the highlights. Insane quarter, insane record profits. We expect a rocky, bumpy ride in Q2, but the future is bright. I don't care if recession comes, right? I want the stock to go down 300, still above my cost basis, but I'll be adding more. And that's my personal opinion. So I'm not sure what you guys think. Again, if you're here, let me know, and appreciate if you guys can actually smash that like button, smash that heart button, subscribe button, and I'll see you guys in the next video. Thank you.